Good morning and welcome everyone to the Moneycontrol live stream. You're watching the opening bell and I'm your host Nikki Mirchandani. Indian equity markets are set to extend weakness due to negative global handover, lack of positive triggers domestically too weighs on the sentiment. Early deals. Indian equity markets are set to end the week now with losses of more than 0.25%. Rate-sensitive stocks are expected to be in action after drubbing witnessed in the previous trading session. Talk about the FII and the DII data. FII have been the net sellers to an extent of 4,933 odd crore. A bit of a change in trend there after being the buyers to a minuscule amount in the last couple of trading sessions. DIIs, on the other hand, have purchased equities to an extent of 5,512 odd crore worth of stocks on Feb 8th. But to bear in mind the fact that Nifty has closed in near low for the first time in the month of Feb. The larger rally is intact till Nifty is about that 21,429 mark. The near-term texture might become slightly volatile, but the problem for the market remains the large private sector banks. Some amount of participation from those and you would see further momentum building up for the markets. Let's talk about the global trade setup. Well, GIFT Nifty at this point of time is hinting at a weak start coming in for the broader index, down with losses of more than 50 out points. And talk about US markets. Well, S&P 500 has closed in little changed on Thursday after briefly topping the 5,000 milestone for the first time on record. Asian markets struggled for traction on Friday after US shares inched to a record high. But look at the Asian markets, they remain partially closed on Friday as the region enters the Lunar New Year holiday period. Also, the China attempts to stem the country's equity markets have slumped in and some amount of weakness has clearly crept in. Prior efforts to arrest market declines, which was notably witnessed in the period of 2015, may not work around this time around as per the consensus view. Earnings that you need to watch out for Feb 8th, you have Godrej Industries, Happy Forgings, Hero MotoCorp, Honasa Consumer, along with that Hutco, IFCI, Alchem Leb, Bajaj Hindustan Sugar, Bandhan Bank and Campus Activewear, along with Kaplan. Cello, DOMS, Easy Trip Planners also will be hogging some amount of limelight. But let's also navigate across the FNO data, or let's just say the FNO ban out there. What has come in new or additions out there is Aurobindo Pharma. Biocon also bear in mind the fact that this company has just reported in the numbers. Punjab National Bank is another entry out there. What has been retained within the list is Ashok Leyland, Balrampur Chini and Delta Corp, along with Hindustan Copper, India Cements and Indus Towers, along with that Nalco. After the sharp upsurge, or rather just say the up move that the stock has been witnessing over the past couple of days, SAIL and UPL also has been retained. Along with that, what is out of the FNO ban is the entertainment enterprises. What I'd also want to highlight is the Jefferies Greed and Fear report, which has made in changes to portfolio. The changes will be made only in India long and only and global long only portfolio. Within the India long only portfolio, Bharti Airtel has been introduced with 3% weight. Investment in RIL is expected to be shaved by 3%. HDFC Bank has been reduced by 2%. Axis Bank and State Bank of India has increased by 1%. And if you talk about the changes that have been made in the global long only portfolio, HDFC Bank, the pressure point, will be reduced by 2%. Axis Bank will be increased by 1% each. That's what we have in terms of the Chris Wood Greed and Fear report. But of course, we are looking at a day, end of the week, an eventful week rather. And we have seen some amount of losses, fair amount of losses creeping in. But let's actually get in our technical guest, Aamar Singh, who is the Senior Vice President at Angelone, who joins us with his views and recommendation this morning. Well, morning there, Aamar. How are you doing? How is the trade setup looking like? Do you think a bit of weakness? How's the texture of the markets? A bit volatile after the sharp decline that we've seen in the previous session?
Yeah, very good morning, and thank you for having me on the show.
Pleasure.
So what we are seeing is that we are seeing more or less consolidation happening, and also and we had the RBI policy, so there was some expectations that maybe there could be a rate cut, but that was, I think, far-fetched in that sense. So markets were really in the know that there's going to be no rate cut. But what we are seeing is that if you look at the major heavyweight constituents of the Nifty, we see that it's been primarily HDFC Bank which has been dragging or not supporting Nifty, or maybe the banks, ICICI Bank, because on the other hand, and Kotak Mahindra Bank. So on these banks, these three banks have not been very supportive. Axis Bank also, to a certain extent, we've seen some sort of correction. But apart from that, be it Reliance, be it SBI, because SBI and PSU banks have really, I would say, rallied significantly sharply. And also, you look at the IT space, be it TCS or be it Infosys. So these heavyweights have actually been driving the index, and to the certain extent, the private sector, these 3-4 private sector banks have been actually letting down the index in that sense. So coming to the index per se, what I see is that I've been saying that the long-term trend, there's no doubt about it, is very strong, remains strongly intact. Even the intermediate term trend is very strong. Short term, we are seeing some sort of consolidation. That's clearly visible on the daily charts. If you look at the derivative data also, that's also, some days we are seeing long built up, but again, we are seeing short built up. And it's primarily these 4-5 major heavyweights, because if you look at HDFC Bank, ICICI Bank, and Kotak and Axis, they have a significant weightage on the index. So till the time we don't see any pullback. But one good thing is that HDFC is approaching a very crucial support zone. So it's below 1400 level. So 1350, 1400, that's a very strong support zone. So we could expect some pullback from there. So if other heavyweights do not see a significant correction, we could expect some pullback in the market. So now coming to the levels of Nifty, I would say Nifty on the downside has got very strong support coming around the 21,480, 500 zone, whereas on the upside resistance is around the 22,000 level. So it's a range 500-point range, which Nifty is actually trading in. But from a short-term perspective, it's more of buying around support, selling around resistance. There's no clear-cut trend in the market from a short-term perspective.
All right. Aamar, I'll also want to chat about Paytm, which is clearly the stock of the day. It's going to be acquiring in ONDC startup Bitsila amidst payment bank crisis. Do bear in mind the fact that, the Bitsila is currently the third largest seller-side platform by transaction on the open network for digital commerce. The deal is right now in advanced stage and will likely close in the coming week, according to two people in the know. That's the report Moneycontrol is carrying right now. Remains to be seen. The deal size wouldn't be at this point of time, couldn't confirm that. And whether it's cash or stock, that also remains to be seen. But Paytm is clearly the one that we need to watch out for. Aamar, comment on this one. It's right now sitting in that ASM stage 1 category. A bit of losses which has already come through for Paytm to an extent of 7% at least. Beg your pardon, for pre-open indicative, that's a 7% loss that we're looking at, Aamar. What's your view on Paytm?
See, Paytm, if we look at the trend, definitely continues to remain negative, and also with regard to the news flows which were there with which actually hampered the up move. So the stock from almost 600 levels, then it rallied towards 800, and again it's down by almost 50%, and that also within a very short span of time. So I would say that in stocks where there's some news which could have a significant bearing on the company, ideally investors or traders should stay away from the stock.
Sure.
That's my
limited
my
point there. Point well taken. We are going to the clear suggestion coming over there is to stay away from stocks like Paytm at the point. But let's address the market open. We are looking at a flat start with a bit of negative bias coming in 21,700 mark, nearly around that level, but remains to be seen. The market texture right now is looking very weak. Further gains, if you see more losses coming in today's session, you'd be able to decide it's the first time in the month of Feb that you saw Nifty closing near that lows level, which isn't really a great sign. But look at the losses for Bank Nifty, over 0.1% clocked in for Bank Nifty. There's a dichotomy of trend which is played out for banking stocks on the budget day itself, and some amount of losses, which is clearly lack of participation from private sector banks, which is weighing down on the sentiment. A bit of recovery there will provide the required solace to the market. Private sector bank at this point of time also, look at the trend, a 0.1% lost in for that one. But there is, like I said, dichotomy of trend playing out within the banking index, and you're seeing that gains coming in, being captured in for the PSU banks. 0.2% of gains clocked in on that one. The mid-cap index also is down and out with trade. 0.25% rather just lost on mid-cap index. And small-cap index, let's pull that up. Well, a bit of outperformance coming in from the small-cap index. 0.1% of gains clocked in on this one. Well, Nifty IT, a bit of losses coming in for that one. 0.1% lost, but we'd like to pull up something in the likes of Paytm, Zomato, and also ITC, because these are some of the stocks which are, of course, going to be in focus, or rather are in focus on account of developments which have come through for Zomato. Clearly, you've slew of brokerages which have upgraded the counter, or rather raised the target price for the counter after the Q3 show that has come through. And apart from that, Paytm, yet another day, some more losses coming in for Paytm. So you're seeing that story is not really auguring well, despite few reports suggesting of the acquisition that is likely to come through. Zomato on the other side, look at that, gains coming in to an extent of 3.5%. Clearly the story of two new age stocks, new age companies, I would say. Talk about ITC, a bit of downgrade coming in for that one as well. ITC is also trading in lower. Let's look at ITC, because there's this downgrade which is coming for ITC. But apart from that, let's pull in the top losers and the top gainers of the day. ITC at this point of time is not reacting too well, down and out with losses to an extent of 0.3% thereabouts. Britannia, Tata Consumer Products and Power Grid, these are some of the other top gainers that we have on the list. Britannia, yet another day of volume growth performance which has likely come through and is auguring well for Britannia. Cipla, Reliance also is one of the top gainers. A bit of momentum is being lent by this index heavyweight. State Bank of India participating into the rally. A bit of fluctuation there for State Bank of India. But let's also pull up top losers just to see how the market breadth is stacking up right now. Advances 24, declines you have 26. Market breadth skewed in the favor of declines. M&M, Bharti Airtel, BPCL. These are some of the top losers that we have. Maruti Suzuki, Hindalco and Infosys. Well, another losers that we have for the day. But Aamar, coming back to you, what are you picking up? Do you anticipated, sure, this was the trend that we all were looking at, but does that reiterate the stance of a weaker texture for the markets, or is just too early call at this point of time?
So I would say that overall, if look at the structure of the market from a short-term perspective, that clearly says that there's a very a tough struggle between the bulls and the bears. So that is clearly visible on the charts from a short-term perspective. But I've been reiterating that the long-term trend continues to remain very strong. So what it effectively means is that we will witness consolidation. And also we have to remember that till the time we don't see a significant pullback in HDFC Bank, because that has almost 13% weightage in the Nifty and more than 30% weightage in Bank Nifty. So till the time we don't see HDFC Bank or ICICI Bank really pulling up, we could witness consolidation because we've seen some very strong performance from Reliance. We've seen strong performance from ITC and TCS and Infosys. But we are not seeing that sort of performance from the private sector banks. However, on the public sector banks, if you look at SBI has been on a tear. It has been rallying significantly. And apart from that, other public sector banks have also performed exceedingly well. So these are the major heavyweight constituents which are actually dragging Nifty. So till the time we don't see a reversal in their trend, I would say we could witness consolidation for some time to come.
Also, Reliance, much of the support is coming through Reliance. It's also one of the top gainers for today's session. Your view on that, and also let's talk about Britannia after that second consecutive session of gains that I remember for Britannia.
Yeah, so looking at Reliance is definitely very strong on the charts. There's no doubt about it. So effectively, it means is that, and not only from a long-term perspective or an intermediate-term perspective, the momentum is there in Reliance. So effectively, it means that over the last, I would say 7-8 trading sessions, we've seen Reliance more or less consolidate after the sharp rally from almost 2650 levels. Currently, it's around 2920 odd levels. So, and one of the technical indicators on the daily charts, they clearly point towards overheating in Reliance stock from a short-term perspective. But Reliance is definitely a buy on declines. There's no doubt about it. Till the time we see a trend change, and that is not happening in a short span, because the long-term and the intermediate-term trend continues to be very strong. So one should be, I would say, buying on dips. Looking at the other stock which you mentioned, Britannia. Britannia is a different, I would say.
See, I stand corrected there. Britannia has lost a little bit of ground in previous session of trade. Almost 4% was lost on the day of reporting. In numbers, sure, there was some amount of gains. And again, you're seeing some momentum building up. So please continue.
Yeah. So Britannia, what we are seeing some sort of profit booking happening in Britannia after the sharp rally from 4,400 levels to 5,400 levels. So right now it's consolidating, but the current levels are very crucial, very important. So I would say that anywhere between 4,800 and 4,850 or 4,900, that's a very crucial zone of support for Britannia. Ideally, this level should hold and we could witness a pullback towards 5,100, 5,200 levels, but that's it. If the stock breaches the 4,800 level, then we could witness some real sharp selling in Britannia. Otherwise, we could witness consolidation in the stock.
Gains coming in for Biocon, right? I mean, just in today's session, of course, it's clocked in some amount of modest gains after previous two sessions of drubbing there. But for the last couple of days, the stock has gained a lot of ground to an extent of 10-11% in the last couple of sessions there. What's your view on that? More steam to the rally?
I would say, Biocon is one stock which has really not performed. If you look at it from a long-term perspective, the markets have hit the record highs, but this stock has been on a decline. If we go back in time, so the stock has more than half from its all-time highs. Currently, there's a pullback from 220 levels. Currently, it's around 286 odd levels. But these are the levels where the stock would meet with selling resistance. So the recent high which the stock made, so anywhere between 300, 310 is a very good exit opportunity in Biocon. So one shouldn't really enter the stock at the current levels. I wouldn't recommend that, because the stock has got strong selling in coming at around the 300, 310 levels. And also the long-term indicators clearly tells me that the stock, even if it rallies, will witness profit booking in the stock. And the stock could go in for some consolidation. On the downside, the stock has now got good support coming around the 240, 250 levels. So I wouldn't recommend buying the stock at the current levels, because the risk reward issue wouldn't really warrant that.
LIC has reported in smart numbers. The net premium income is up by 4.7%, but look at the net profitability is almost up by 50 odd percent. VNB margins have expanded to 18 odd percent from 15 odd percent in the corresponding quarter of the previous year. Trading near the record rally, and of course we saw the PM endorsement of sorts when it comes to the performance of PSU, and LIC also was spoken about in brief details. And today's session we are seeing sharp up move coming in for LIC, 3.5% clocked in on that one. What do you make out of that, Aamar?
Yeah, LIC, I've been bullish on LIC, and I've been definitely recommending that LIC is one stock one can look at from an investing perspective, because the stock is very strong on the long term and the intermediate term trend. Even the short term trend continues to be very strong, and momentum is there. And the best part is that we are seeing significant volumes and delivery quantity happening even at these levels. When the stock breached the 900 level, then the 1000 level. So that also, and it felt that maybe this is highly priced. But if you look at the structure of the stock is definitely headed higher. I've been talking about the stock from 900 levels. Currently, it's around 1140. This stock has all the potential to rally towards the 1250, 1275 levels. So any correction is a buying opportunity in LIC from a medium-term perspective.
All right, Aamar, we're just going to leave it at that. And thank you so much for taking out the time and having this conversation here with us.
Thank you.
All right, a lot of dichotomy in trend playing out for the private sector banks along with the PSU banks. A bit of confusion. Is it really the calm before the storm? How is the market texture really stacking up? Let's get all the answers from Sahil Kapoor, who heads the products and market strategy at TSP Mutual Fund. Morning there, how are you doing?
Good morning, Nikki. I'm doing very well, thank you.
All right, let's start off with the basics. Just reading through your reports, and you spoke about a bit of calm being and the low volatility era. Would you want to dwell more on this? Also, we've seen the number of days when it comes to both small cap and the mid cap index, which has risen by 1% or more. It's near the previous best years in 2023. What does that mean for the market right now?
Sure. So, Nikki, what we've seen historically is that volatility moves in cluster. You have periods when vol is very, very high. That means market fluctuate a lot. And other periods when volatility is slightly lower. Currently, the phase that we are in, last about 8 years, we've seen volatility has been very low. And let me quote some numbers. We define a bear market by saying that if the index declines more than 20% and stays there, that means stays below an all-time high for a year or more, that is one definition of bear market. And if you go by this definition, the last time we had a decline and the market could not recover within a year was way back in 2015-16. COVID decline was very, very deep, but the market recovered to a lifetime high in about 9 months. So participants haven't seen a very long period of decline and a very slow recovery, which means that the sentiment is still robust. People believe that buying on dips results in excellent returns, and it has. And therefore, I think it probably blunts people's expectation of deeper declines. Second, as you said, we've had 2023, which had in small and mid caps one of the top 2 or 3 years of what I have written as unsettling calm. That means markets climbing slowly at a slow pace, but every day. And there are very few declining days during the year. When you put these data points together, it tells you that participants may not be ready for a large decline in markets or heightened volatility in the markets, which I think is a red flag. And secondly, when you marry these numbers with where we are trading in terms of valuations, where we are trading in terms of overheating of the market, it does tell you that it is time to be cautious about the market trend, at least in the for the next few quarters.
Okay, your report also, I don't want to be the bearer of the bad news on a day when we are looking a bit of volatility around. But the BSE Sensex has now gone for almost 8 years without a bear market. That's the scenario you've painted on in your report, of course. Do you think it is the start of the bear market this year itself? What kind of returns can one look at? Let's not forget it's also the election year. How are you looking at it?
So, Nikki, I don't have any crystal ball, right? It's very hard to, predict whether markets will decline or not. All what we are saying is that historically, these periods of low vol has been followed by periods of heightened volatility. Now, the question is, when does volatility go up? I don't think I or anybody else has that answer, right? That date or time, nobody knows. The idea is that if you look at historical data, it tells you to be cautious right now. When that correction occurs or within 24, 25, I don't have a clue right now, but largely it tells you that this is the right time to be cautious. If I were to pick a spot, say, I would look at, valuations more closely. So, for example, we spoke about mid and small caps. Look at price to book of, let's say, micro cap index, which is the, Nifty 501 stock to 750, or for that matter, look at mid cap and small cap. So that means if you leave aside the top 100 stocks, go from 101 to 750, on an average, the price to book multiple for this universe is trading at one of the highest levels that we have on record. I think the only higher high that we could see was in 2006. So going back in history, this is the valuation that most of these indices are trading at. So I think it pays to be cautious right now. And it makes sense that if prices are cheaper, those entry points will be more suitable.
Let's chat about the banking index. Of course, there is a bit of underperformance that has come through as compared to Nifty in the calendar year 2023. And the valuations that your report also suggests that it's traded below, the entire index is traded below 2 times price to book value in Jan 2024. Of course, on the budget day also, we're seeing fair bit of dichotomy playing out between the PSU and the private sector banks. And going by that logic, at least on the face of it, it looks like private sector banks are still, a bit at the premium as compared to the historical averages. But how would you look at it?
So, let's look at 2-3 numbers. First is when you look at credit growth, and if you separate private banks and public sector banks, you'll see private banking as a whole, the credit growth is upwards of 25 to 30%. depending on how you look at the averages. If you add one or two large NBFCs, the number will be between 22 to 28%. Same universe, if you look at PSU banks, the growth is between 12 to 15%. Secondly, when you look at the asset quality for private bank is much better, at least the top five in comparison to the public sector banks. Although I don't think it is the most important trigger right now, because asset quality as a whole is improving, right? And number three, when you look at historical valuations, many of the PSUs which are trading at 52-week high or 5-year high today, for that matter, I will not name a stock, but there is a PSU bank trading at about 4.5-5 time price to book, but the consolidated 15-year PAT for that company is 0 rupees or negative. They have made consolidated losses over the last 15 years, right? So it pays to be more bottoms up. You can't paint all PSU banks or private bank with the same brush. I think there are opportunities also in PSU banks, the larger ones, of course. So I will not paint them as a bucket, private or PSU. Largely, I will look at it from purely from a bottoms up perspective. But on the whole, it does appear that banking and financial services is a much more leaner place where valuations are much more attractive. Margin of safety is much more higher in comparison to the broader market. And when you compare numbers, the PAT growth for this universe is between 15 to 20%. You know how you slice and dice, right? And if you look at top line growth for this universe, again, between 15 to 20%. If you exclude banks and look at the aggregate PAT growth for the universe, it's less than 6%, right? So there is, top line growth is less than 6%, although PAT growth is still going strong at 22%. So when you look at the numbers, when you look at the margin of safety in valuations, from a longer term perspective, I think this is a sector to be in, avoiding or ignoring the short term noises that we are seeing. I think we are much better off placing higher weightage to this sector over the next 1 or 2 years.
Sure. By virtue of that, enough and more damage has been done to HDFC Bank also. We've seen fair bit of losses coming through for HDFC Bank. In fact, in today's greed and fear report from Jefferies, we saw there is a bit of, rating which is going to be, or let's just say weight, which is going to be reduced in for HDFC Bank. What's your view just on that bank?
So I won't be able to give you a stock specific view, but, just to put it in a few words, I think a stock wouldn't do well for 2 quarters is probably one of the, better outcomes that a holder can ask for. So I think it's a natural tendency of businesses to go through cycles, and we need to look at bottoms up financials for most of these stocks, and I think they are doing quite well. The transition period could be anybody's guess on how much time will it take, but I think from a longer term perspective, this full basket appears to be having a lot of margin of safety.
Right, that's pretty much a smart way of putting across that the stock is now trading a bit cheaper after the 2 quarters of underperformance that it has seen. That's also the valuation bit that we're talking about, but it's also the year where you're seeing the entire world population going into the election mode, most of it, majority of it, let's put it that way. With that said and done, with the kind of dynamics that India is sitting with, do you think FIIs will come back in a big way in the market this year, or you think this year again is going to be a disappointment of sorts, or rather a place where DIIs will continue to support the market as it has been for the last couple of years?
So, Nikki, what we've seen historically is that FIs the flows have been very patchy. We haven't had significant amount of flows for a consistent period of time. For example, for FY21 and 22, cumulatively we saw varied numbers. We had a huge inflow of $37 billion post-COVID, and then for 2 years we saw outflows. And then last year we saw respectable flows of about $20 billion inflow. So the overall trend is very patchy. We don't have any significant data points or indicators to tell us whether FIs are going to come in hordes. It is, I think, still a hope. All the conditions are right? India has delivered earnings growth. It has delivered investment returns. Currency has been stable. So much so that currently rupee has traded in a 3.7% range for the last 16 months. And this is the narrowest range going back to 2002, right? So interest rates have been in a very, very narrow range, right? So all indicators have been very stable. Yet, when you look at a console level, if you add FDI flows, FPI flows, ECB, FPI debt flows, we have got just what we get on an average, just about 70-80 billion dollars. So we haven't got a very large amount of inflows yet. Can it happen in the future? I think conditions are ripe. But my guess is that lot of FI money is also looking at what is the global risk-free rate, right? Currently, the US Treasury paper is yielding anywhere between 4.20 to 4.5%. And that makes a lot of sense for a number of large investors or institutional investors who haven't seen these kind of risk-free rates for a very long period of time. For about 15 to 16 years, rates were between 0 to 2%, right? So there is a competition for returns. And I think that probably is sort of stalling large amount of flows to emerging markets. And emerging markets as a basket has also not done well, of which we are a part of. So the answer to your question is I'm not sure how sticky these flows could be. And secondly, I think, as you pointed out, volatility has been very, very low. And if that goes up, then probably we'll have a dry spell once again.
All right, Sahil, I also want to chat about the consumption story. How is that stacking up for you? We've seen some of the biggest downgrades coming in for the paid company, HUL for that matter, and ITC in today's session, where Jefferies has come up with a downgrade rating saying that the stock has almost returned more than 3 times from the bottom levels, led by the strong cigarette demand, or for that matter, scale up in FMCG, improved capitalization. On back of that, there's a downgrade which has come through. Do you think in this quarter itself, we saw some amount of green shoot coming in, at least from Britannia, when it comes to the volume growth profile? How are you looking at the entire consumption story? What do you like within that space?
So largely, Nikki, we've been tracking this space, and we wrote about this earlier also, that there are some green shoots, but only in comments. So when we hear some management commentary, some of the managements have started to speak about the pickup, but it is yet to show up in hard numbers, right? When you look at the top line growth, even the quarter which went by, for which the results have come out, the aggregate top line growth for your revenue growth for this universe is just 1%, right? Which is nothing to talk about really. And even if you look at the domestic consumption basket as a whole, the revenue growth was about 12-13%. And if you exclude the internet companies in the consumption basket, the revenue growth was less than 10%, right? So nothing exciting to talk about. And secondly, when you look at alternative data, for example, rural wage growth, for which the government of India gives out numbers, is still trending at below 4% YOY. When you look at IIP, which is labor-intensive IIP, the numbers are in low single digits, right? So alternative sources of data are yet to turn and tell us that consumption has, seen a very large uptick. And on the whole, when you look at, private final consumption expenditure, which is part of the GDP number, that has been trending below our pre-COVID natural growth rate or average growth rates. So consumption is still patchy, and I think we are yet to see a recovery. We'll be happy to see a recovery and probably participate, but we'll wait for those numbers to materialize.
Sure. Let's talk about something which is a little more exciting, at least on the face of it, it looks like. I was actually chatting with Rahul Arora, who is the CEO of Nirmal Bang, and he suggested that in this year, defense stocks perhaps will not even be able to beat the returns of fixed deposits. After the sharp outperformance that we've seen in the previous year, within the PSU basket, he just prefers the banks right now, done away with railways and defense story. Do you echo the same sentiment?
So I would say that that is one of the probably areas which has a long-term promise, but valuations have run up, right? So it is anybody's guess on, 1 year is too short period of time to, give you a highlight whether they can go into a consolidation or not, but valuations have gone up. We've been, participating in defense stocks for over 4 years now. Some of these stocks, in this sector, we've been significantly invested, and we've seen, multiple times re-rating happening. I remember that way back in when we were chatting about some of the defense companies, they were trading in low double-digit or even single-digit price to earnings multiple, and now they are close to 35 times or so. So we have participated. in this bucket. But I think incrementally from where we are in terms of valuation, earnings growth has to come up, has to deliver for them to continue this kind of performance. But yes, there is a possibility that we may not repeat the kind of returns that we've seen over the last 3 years in the next 1 or 2 years, and largely because of the valuations that these stocks are at.
Okay, final question that I have is, what is really DSP interested in right now? What are you buying at this point?
Sure. So largely we are focused on 3 buckets, as I told you, BFSI being one, both lenders and non-lenders, particularly I think NBFCs appear to be, geared up to, go through the next cycle, and even non-lending companies in terms of insurance and both life and non-life are throwing up a lot of opportunities. Second sector is healthcare, where I think pharmaceuticals, path labs, and specialty medicine companies. Many of these throw up a lot of opportunities. Top line growth has started to move up after a lull period of about 3 to 4 years ex of COVID, and we are seeing numbers climbing up at a fast pace. Profitability is very, very good for these companies. So that again I think is a very good space. And third is within consumption auto, and within auto I think some amount of two-wheeler space is something that we are quite positive on. Where we see opportunities coming up. And recently we saw some correction in some of the consumption names. And there also, I think we are, interested to look at opportunities going ahead. So this is the space where we feel that margin of safety is much better. And of course, we are also looking at alternative assets, looking at multi-asset strategies like gold, where we think, there is an opportunity to participate and hold, where it gives us required diversification. And the last is, playing out bonds through duration. We think that they offer a lot of value today. India GSEC at about 7.2, 7.3% YTMs and appropriate duration. I think that is a very good asset class to diversify into.
All right, Sahil, we're just going to leave it at that. And thank you so much for taking the time and joining us here.
Thank you.
Well, the primary market action is also something that we need to chat about, and often more needs to be covered here. Entero Healthcare Solution, that company will be coming up with an initial public offering today, and the price band is in the range of 1,195 to 1,258 per share. Capital Small Finance Bank, its day 2 issue has been subscribed by as much as 1.2 times, and Jana Small Finance Bank too. Subscribed by 1.83 times. The Rashi Peripherals, which is the final day, the issue has closed, and of course the issue overall was subscribed by 3.19 times. Today is the final day 3 for Rashi Peripherals. Thus far it's been subscribed by 3.19 times. I stand corrected there, but with this it's a wrap, and goodbye from the entire team who puts this piece together for you. Thank you so much for watching. Please do post your feedback for us in the comment section below. Follow us on the link at the bottom of your screen, and do stay tuned in for more. Coming up next at 11:30 is the management of Entero Healthcare Solution. We'll chat with the management and get to know more about the insights. But with this, it's a wrap and goodbye.